Welcome to TheoTrade. This is Don Kaufman. It's October 22nd, 2018, and you are watching the TheoTrade evening video. All right, markets closed just moments ago with the S&Ps down 10, the Nasdaq up 50. A tale of a very large divergence in today's trade. But I got to tell you, that is not what is on my mind. My major focus today is none other than the XLF. Now, I covered it in this weekend's video. I covered it ad nauseum all throughout the course of last week, and we've talked extensively and specifically about the XLF and the 2650 level. Nevertheless, it has now broken to the downside. Now, back up for just a second. You're probably thinking at this point, oh, that's great. Don has a position on in the financials, and I absolutely do have a position on in the financials, but that's not why we're looking at the financials. The financials are arguably the most influential sector inside of the S&P 500. Everybody's got their head towards, let's talk about tech, let's talk about tech. Well, today, there was a capital rotation. Want to talk about tech? Capital rotated out of the financials into some of the monsters of tech. Okay, but the problem is, with financials now effectively at what? Take a look right now, 26, all right, and change. They cracked under that threshold of 2650, and such an important threshold, which I'll show you here momentarily. With that, it has literally kicked a leg out from under this entire marketplace. In fact, let's take a look at a couple of the individual financials. And first, we're going to start, okay, generally speaking, with the XLF. So in this case, I'm going to pull up a 3-year just to show you how incredibly important this particular level happens to be. And again, you kind of see the line across the screen. I'm going to highlight that for just a moment. We are, again, broken loose at the 2650 level. And you got to go back now, what, over a year to find the financials at these lows, which kind of begs the question. You know, you're talking about a marketplace, and if you look at the S&Ps, let's go ahead and bring up the S&Ps, and this is the spiders. The S&Ps are still holding gains in the year. They're up 2.3% year to date. That's just a year to date. Again, let's highlight this for a moment. Happens to be a year to date. That's the spiders. There's 2.3%. Now, cruise over to the financials, because I'm going to show you something here in a minute that's going to shock you. The financials, first of all, are at their effectively their lows for the year. Okay, and why is this so important? Well, I mean, listen, we're going to bring up some individual stocks, whether Goldman Sachs or JP Morgan, or Bank of America, and Wells Fargo, and Morgan Stanley. I'll bring those up in a second. You do realize that this entire year, what have financials had going for them? Well, first of all, they threw some more deregulation at them. Where do you see deregulation? I don't see it. We're just slipping to the downside. They had tax reform that's supposedly going to be helping them substantially. Maybe that was priced in, okay? Oh, wait, they've had interest rates that are going up. Interest rates going up has really only kicked into high gear this year with the number of rate increases and, of course, the Fed pulling the balance sheet. What gives? The financials can't get out of their own way. Again, this is a sector that if you're into, you know, what corrective territory happens to be, this is, again, on a year-to-date basis, but just the last couple of weeks, we were roughly up about 4%. Now we're down over 6%. That is full-blown correction and corrective territory. If you went from year-to-date, we are up just about 9%. Now we're down. Okay, we're almost in bear market turf. If you were to pull this up for a full year, again, we are, and we're up about 13%, and now we're down about 2%. Again, we're beyond corrective territory inside of the financials. Now, let's get to a couple of specifics because, you know, there was deregulation, tax reform, the interest rates have up. All of those are supposedly what? They're going to help the financials. Okay? The only thing the financials need is just that, is help. Goldman Sachs down just shy of what? 8.5% on a, again, on a, that is a year over year. We'll snap that back to a year to date. On a year to date is actually down 13% year to date, which is Goldman Sachs. Cruise over to Bank of America. Bank of America is down 8.4%. If you want to get really specific, JP Morgan. Now, I'm going to spend a moment here and look at JP Morgan because here's where I actually have, okay, one of my larger bearish positions happens to be specific in JP Morgan. It's working, people. We actually shorted. JP Morgan was up about 7%. It is now down, okay, with the rest of them. This one's one of the better performers, only about 1.5%. Citigroup getting hit hard, down 10%. Wells Fargo, I could just skip that one, down 15%. Morgan Stanley down about 13%. Again, this is absolutely critical. What's causing some of the sell side activity? Listen, the what in that question, okay, doesn't matter. At this point in time, all we know is we have the financials, which again are arguably the largest sector, kicking a leg out from underneath the market. What you have to look at in the XLF is this has now opened the door for the S&Ps to take a substantial leg lower. Question is, in the next few days, are they going to take the bait? They're going to sell the marketplace off, and I'm going to talk about that here momentarily. One other aspect I think you need to be aware of, this one also kind of caught me off guard. I've got a style built in here. Let me cruise over to it under sector comparison. And all I'm doing, and I know it's the giant spaghetti bowl, this is actually a 1 year period of time, and each one of these lines represents a specific sector. But if you look very, very carefully at the worst performing sector, can't even believe it, it's the financials. It's now the worst performing sector, okay, in the S&P. And again, it's arguably the most influential sector in the S&P, and that happens to be over a 1 year period of time. If you want to snap this to a longer period of time, even over like 3 years, okay, over a 3 year period, it's also still down there. Okay, not quite bottom of the barrel, but again, not even close to what you have in terms of technology. So the only thing really holding us and what's left in this marketplace, if we cruise back over to the XLF, snap to it. All right, the only thing really holding the entire marketplace together at this point in time, and I'm cruising back over to a 9 month, all right, look at the break under 2650, is none other than a number of underlyings that we all know and love, the monsters of tech, that are still rather unscathed. Now, I cannot stress this enough because we are facing the earnings announcements. When? Well, this week. Thursday this week is absolutely pivotal. Microsoft, and again, I want to zoom out for just a second when I talk about underlyings that have been unscathed. We all have to agree we've seen some sell-side activity. I can't go as far to say as this has been unprecedented volatility, because I don't think it really has yet. I mean, we had some wild trading sessions, but a little perspective here for a moment. You look at something like Microsoft, and this one screams to me, okay? It has been untouched. I mean, come on. You're talking about underlyings, like the Goldman Sachs or like a Bank of America that are down 10 or 15%. What's Microsoft done? Oh, it's still up 30%. Well, you want to take a look at Apple? It's still up what? 28%. You want to take a look at Google? Obviously, I skipped over Facebook. Oh, come on, it's fair. Facebook has had quote-unquote issues. Google, kind of middle of the road, only up about 3%, also facing some issues. Okay. Then, of course, we come to Amazon, 50%. Again, underlyings that have been unscathed with absolutely massive market cap. The risk out there is all on them. And the irony is, Thursday is their earnings. Whether you want to take a look at Amazon, well, you're going to have to wait till when? Thursday. Again, Wednesday, Thursday of this week is going to be Mr. Toad's wild ride in terms of earnings. Again, here's one on the 25th. All right, Facebook's got a little bit more room before the earnings. Microsoft, though, also aligns for later this week. Wednesday, Thursday this week is mega market cap for earnings. Be aware of that because this could be the turning point for the entire marketplace. Clearly, the financials are no longer supporting this marketplace. As for those of you interested in the bearish positions I have on, I am still maintaining the bearish positions in the financials or in JP Morgan, and I'm going to ride that one off into the sunset, at least for the time being, to get a better feel. Again, if real unprecedented volatility is going to hit this market, quite frankly, I just haven't seen that hit yet. One other thought kind of comes to mind over here. We focus so much on these financials kind of breaking down because it is absolutely pivotal, right? Not only are they breaking down, they're doing it on much heavier volatility. I mean, the financials have already been through earnings, yet their volatility, again, this is the XLF over the next 4 days, their volatility is nearing 27%. Or meanwhile, you have a VIX that's just shy of 20. So again, there's almost 25, 30% more volatility packed into the financials at this point in time. All right. One of the things that I often think about is, so great, the financials are breaking down, could very well suck the entire marketplace underwater. At the very least, we know that it's opened up the door to allow the S&Ps to fall out of bed. What kind of positions can I take? Should I go after some of the technology positions? Well, that could be kind of dangerous. I mean, listen, I don't mind saying this to you. Microsoft, it's got earnings coming up. Do I really want to get involved in that? Well, maybe, but the expected move, it's $5.50. I could get run over in this position. Would I want to go out? Would I want to short Microsoft? I mean, who doesn't want to short Microsoft? I know I do, but at the same time, is it going to be prudent for you? So I look for underlyings in a position like this that have been relatively unscathed, and one of the ones I've come to is none other than, a position that we put on today happens to be Disney. Now, I used a deep in the money, a deep in the money long put. It's a synthetic short strategy. Why? Because Disney is effectively at multiple year highs. Now, if you go back over the last 5 years, Disney, again, kind of a chopped out ride in and around anywhere from the 100 level on up, and this is clearly at the upper edge of that level. The one thing that kind of always resonates with me in a marketplace like this, the correlations are getting there, meaning that the correlations are growing. That is, if the S&Ps move, most of the sectors are moving kind of with the S&Ps. Disney happens to be kind of the odd stock out. And if we're going to see kind of unprecedented volatility, if we're going to see the markets really get tagged in the next couple of weeks, you're going to see Disney fall with it. This is a duration position, And again, Disney, am I going to have to carry it through earnings? Absolutely. But I'll reiterate, this is a duration position. This isn't about me going out and saying like, I want to get short Disney for tomorrow. This is, I want to get short Disney, and I want to stay short Disney because it's at the top of a range. It's in a marketplace that is primed with the door open to fall. And I think I've got plenty of room. This is great risk reward. What's my real risk in here? And you can kind of surmise this for yourself. What's my real risk? You want to get crazy? What, it's going to trade up to 130? Do it to me. What's the downside potential? Phenomenal. And that's the kind of setups and the kind of trades that I often look for. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.